Welcome to Think and Grow Exponentially. My name is Mark. I've been passively and actively investing for nearly a decade now and wanted to share my 5 biggest stock market investment mistakes so that you do not repeat them. All mistakes, examples, and numbers are real. Be ready to see some pain. Also, each stock was bought after doing extensive research on the company's financial strength, profitability, valuation, and future potential. Mistake number one: lack of diversification. Cost of mistake: $4,139. I'm a value investor who believes in buying quality companies at cheap prices. This is equivalent to buying a pair of Nikes at an outlet store, brand names at bargain prices. In the past decade, I heavily invested in the energy sector, hoping that the companies would rebound. Unfortunately, it never did. All the companies listed here are industry leaders bought for cheap prices. National Oil Well Varco was near a 1-year low, Kinder Morgan Energy 2-year low, ExxonMobil 5-year low, Chevron 6-month low, and Royal Dutch Shell 7-year low. Despite buying each for a low price, every single one of them was a loser. NOV and Kinder Morgan were sold at losses. Exxon and Chevron underperformed significantly at 3% compared to the S&P 500's 13% annualized return. And although Shell seems like a winner, if I held on to the stock, it would be a loser today. At one point, 5 out of 18, or 28% of all my stock picks were energy. The energy sector only represented 7% of the S&P 500 in 2016, which means my concentration in energy was 4 times the S&P's. Now, energy represents a measly 2% of the S&P 500, and I lost $4,139 in the process. Mistake number 2: timing the market. Cost of mistake: $6,776. If you look at the history of the US stock market, you will notice that the market goes through cycles. The market rises for years, hits a peak, dips a bit, then bottoms, rises up, hits a peak, dips, hits a bottom, and repeats again and again. After observing the market for a handful of years, I began to worry that the market would dramatically fall due to daily all-time highs. So I decided to move my money into more conservative investments. Big mistake. Timing the market produced a greater loss than energy stocks. Here's a chart of the S&P 500 for the last 30 years. I covered up 2011 to 2021 to highlight my journey over the past decade. I started investing on December 23, 2011 into a bond index. A few months later, I quickly transitioned into stocks, realizing that I was too conservative and wanted more growth. From April 2012 to July 2016, my investments made a nice gain. However, I was becoming nervous. Based on past history, the market looked like it peaked and was on the verge of dipping and then reaching a bottom. So in 2016, I decided to convert my stocks into a money market fund, waiting for the crash. The crash didn't come until 4 years later due to the pandemic outbreak in March 2020. Thinking that we were at the start of the pandemic, I expected the market to fall even further. Instead, the market quickly recovered and I missed out on the crash. I gave up on timing the market in July 2020 and converted my conservative investment into growth stocks. By then, I lost $7,137 in the process. Here's another graph comparing the 4 different types of investments I made for this account. The black line represents what would happen if I never tried to time the market. At a 217% increase, my money would have doubled in 8.5 years. Instead of doing nothing, I tried to time the market. The Frankenstein graph that connects the black line with the blue, orange, and pink shows my attempt at timing the market. The blue represents money market, orange a mix between bonds and stocks, and pink 100% growth stocks. If you compare the Frankenstein and black line graph, you will notice a significant loss in opportunity from mid-2016 to 2020, which ultimately affected the final value in 2021. After 2 years of opening my first investment account, I thought I was ready to pick stocks individually. As a result, I opened another Roth IRA account, strictly for individual stocks, a play money account. For 7 years, I researched, bought, and sold individual stocks and definitely came out positive, producing 9.14% annualized returns. However, this paled in comparison to the S&P 500, which returned 13.79% over the same time period. A 4.5 underperformance may not seem like a lot. After 2 years of opening my first investment account, I thought I was ready to pick stocks individually. As a result, I opened another Roth IRA account strictly for individual stocks, a play money account. For 7 years, I researched, bought, and sold individual stocks and definitely came out positive, producing 9.14. For 7 years, I researched, bought, and sold individual stocks and definitely came out positive, producing 9.14% annualized returns. However, this paled in comparison to the S&P 500, which returned 13.79% over the same time period. A 4.5% underperformance may not seem like a lot, but the decision to go from passive to active investing cost me $12,264. Just a reminder that all accounts made money, at least 9% annualized returns. However, if I did not make these mistakes, I could have made over $20,000 in improvement. Mistake number 3, buying outside my circle of competence. Cost a mistake, $7,463. Warren Buffett and Charlie Munger are two of the greatest investors of all time, and I follow their 4 filter strategy to determine if I should invest in a company or not. 1, is it within my circle of competence? 2, does it have a durable competitive advantage? 3, does it have able and trustworthy management? And 4, is there a margin of safety at the current price? I'll go over the 4 filters in detail for a future video because there's a lot to unpack. In the meantime, I want you to know that the companies in this mistake passed through most of the 4 filters, but failed the most important one. Is it within my circle of competence? So what is a circle of competence? Here is an example of circle of competence in simple terms. The black circle represents what I know. I am a teacher, so I know what the day-to-day life is like for a teacher. The dotted circle represents what I think I know. My brother is a lawyer and provides legal aid for those underserved. I can talk to him about his job, read his company's website, and do my research, but this only represents what I think I know about his job. Everything outside these 2 circles represents what I do not know. My brother-in-law is an engineer. All I know is which company he works for. I have no idea what he does at the company, so my understanding of his job is outside my circle of competence. All 4 of these companies passed through most of the 4 filters. They had near monopolies in their industry. Most were over 100 years old, were led by trustee management, and their prices were at yearly or multi-year lows. Despite conducting extensive research into all of these companies, each belonged in the what I think I know category instead of the what I know category. They were outside my circle of competence. I never saw any of these companies in real life, not in my neighborhood, not at work, and not on the local and national news. Regardless of how much I tried to make myself believe it was in my circle of competence, they simply were not. All 4 companies were sold at a loss. The share price of National Oilwell Varco and Kinder Morgan are significantly lower today. Chicago Bridge and Iron Company merged into another company, which eventually declared bankruptcy. And BHP's share price didn't really do anything for 4 years. Investing outside my circle of competence cost me $7,463. Mistake number 4, attempting to beat the market. Cost a mistake, $17,098. Ouch. Before exploring active investing, I spent a significant number of time studying successful billionaire investors. Warren Buffett, Peter Lynch, Benjamin Graham, Walter Schloss, Seth Klarman, the list goes on and on. Having seen their returns average 20% or more per year, twice that of the S&P 500, I thought that I could study their investment philosophies, strategies, and portfolios to do better than the S&P 500. Going from passive to active investing was a 5-figure mistake. After 2 years of opening my first investment account, I thought I was ready to pick stocks individually. As a result, I opened another Roth IRA account, strictly for individual stocks, a play money account. For 7 years, I researched, bought, and sold individual stocks and definitely came out positive, producing 5.31% annualized returns. However, this paled in comparison to the S&P 500, which returned 9.39% over the same time period. A 4% underperformance may not seem like a lot, but the decision to go from passive to active investing cost me $17,098. Yikes. Mistake number 5, selling early. Cost of mistake, unknown. People have different reasons for selling a stock. One might decide to sell because it reaches a price target, a better opportunity comes along, or one feels that the business will decline. All the companies listed here were sold with a holding period less than 3 years. To help you better understand all the columns, the buy and sell prices listed are adjusted for both dividends and splits. Annualized return is the measure for how much the investment has increased or decreased on average each year. And potential gain loss shows what would happen if I continue to hold on to the stock. Based on my sell history, selling Royal Dutch Shell and Toyota early were the only good decisions I made. The rest would have been great companies to hold on to. Walgreens doubled in price. Nintendo quadrupled. Hewlett-Packard quintupled. Intel tripled. Coca-Cola made good growth, and Aflac doubled. The pain of selling early can be seen by comparing the actual sale versus the potential sale. For example, selling Hewlett-Packard was a $21,000 mistake. The reason I classified the cost of mistake as unknown is because the money from these sales allowed me to buy other companies, so it's difficult to calculate. As a reminder, here are my 5 biggest stock market investment mistakes. 1. Lack of diversification. Remember to diversify to minimize your risk. 2. Timing the market. The market can go up, it can go down, it can go nowhere, but generally speaking, the market does go up and you don't want to miss out on those opportunities. So invest regularly. 3. Buying outside your circle of competence. Invest in what you know, not what you think you know, because you actually don't know what you think you know. 4. Attempting to beat the market. Invest passively unless you enjoy studying finance and don't mind the risk. And 5. Selling early. Buy and hold forever unless you have convincing evidence that you should sell the company. For the past decade, I taught myself how to invest in the stock market. I may have made tens of thousands of dollars in mistakes, but I gained immeasurable wisdom. My burning desire to learn and invest in the stock market improved many of my personal habits. I became better at budgeting, saving, earning, planning for retirement, and living below my means. Every paycheck, I was ecstatic to use the surplus money to invest. I also learned a lot of life lessons unrelated to money from listening and reading what 60, 70, 80, and 90-year-old successful investors had to say. This includes marriage, integrity, reputation, and philanthropy, just to name a few. Before I wrap up this video, I want to leave off with one final quote from Warren Buffett on how to dramatically minimize investing mistakes. Investing is not a game where the guy with a 160 IQ beats the guy with a 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. If you like what you saw today, please don't forget to like and subscribe below and tell your family and friends about this channel. Thanks for watching, and remember, think and grow exponentially. Take care.